those of us who haven't met, my name is Ross Overline, and I'm the CEO and co-founder of Scholars of Finance. And we are fortunate to be joined by Scott Mather, the CIO of U.S. Core Strategies at PIMCO. This is especially exciting for us as Scott oversees global ESG portfolio integration and sustainable investment activities, and is joining us to talk about green investing, which is a very timely topic for us at Scholars of Finance, our desire to make finance a force for good. Of course, with the new administration on Capitol Hill as well, for so many reasons. So for the first 25 to 30 minutes, Scott and I will share a discussion centered around sustainable investing. And then for the second half of this discussion, we'll open up to Q&A from all of you on the line. So if you're able, we encourage you to turn on your camera so you can talk with Scott face to face over the course of the next hour, and also especially during the Q&A. If you have a question come up while Scott is speaking, make sure to write it down, and then I'll let everyone know when we're about to start going into Q&A, and we'll use the raise hand feature to build up our question queue. So if you want, you can even just raise your hand in Zoom while we're having this discussion, and we'll call on you in the order that you raise your hand. So with that, I will jump right in. And first, I want to share a bit more about Scott. As I mentioned, Scott Mather is the CIO of U.S. Core Strategies and a managing director at PIMCO. He is a member of the investment committee and a generalist portfolio manager. Scott also oversees the firm's global ESG portfolio integration and sustainable investment activities. Previously, he was head of global portfolio management. Prior to these roles, Mr. Mather co-headed PIMCO's mortgage and asset-backed securities teams. And prior to joining PIMCO in 1998, Scott was a fixed income trader specializing in mortgage-backed securities at Goldman Sachs in New York. Scott has 26 years of investment experience, and he holds a master's degree in engineering as well as an undergraduate degrees from the University of Pennsylvania. And at PIMCO is a leader at a firm overseeing over $2 trillion in assets with several thousand employees. It's having a massive, massive impact on the world's transition into sustainable investing. So Scott, thank you so much for joining us. It is an absolute pleasure to have you with us today.
No, thanks. My pleasure to be with you guys.
Scott, to kick us off, why don't you just start us off with a little bit of your background and your story, sort of the off resume, where you came from, how you've gotten to where you are today, and why you're so passionate about ESG.
Yeah, well, when you reflect on those kinds of things, it's always tough to really know what the magical moment was. But I got, studied engineering and studied finance in university. That was actually in a PhD program in engineering, and I decided one of the things I really missed. I loved the research aspect of that, but one of the things I missed was the daily interactions. How markets function and how almost everything that happens has some impact in financial markets. And so I thought I would try trading, and so that's how I started. At Goldman Sachs doing that. Quickly fell in love with a client of mine, which is PIMCO, the firm that I work for now, who became the biggest counterparty and probably still is of many investment banks, because was doing things a little bit differently, maybe a little bit more of an academic sort of approach to financial markets and investing. And that was very exciting to me. And I thought, well, it will be a more interesting journey. And of course, it's been a very interesting journey. I've had the opportunity to do many things for the firm and move around a bit, lived in Europe and headed up our offices there for 6 years, as an example. Now, when I came back and I had this opportunity really open up before me, was when I became really focused on, one, a new responsibility for heading up our U.S., sort of funds business, but two, noticing we were doing really interesting things related to sustainability, something I've always cared about, and maybe it's just innate or something like that. And I think it's probably innate for almost everybody at some level, with a different focus on what you're most interested in. But I saw that, and I also saw that at least my vision of the future was that it would be more and more important for financial markets, and it actually turned out to explode in terms of what it means to financial markets in the past 5 years. But seeing that, and also being in the unique position I was in, having done many things for the firm, I was able to get the resources together and get the executive team together to commit to being a leader in this space. And with the idea we can provide the best solutions to clients in the space, but we also have a special responsibility as leaders, given the size of our firm. So, we have, and we do, and will continue to sort of shape the way that the markets develop in this space. We think we could do that in a way like we've done in other things in history, whether it's talking about developing derivatives markets and being some of the first people to really get some of those things going, or investing in commodities in the way that we do today, those types of things. So yeah, that's how I kind of got into it.
Thanks, Scott. I appreciate you sharing. A follow-on question I'd love to ask, just to kick us right into a conversation about ESG and sustainability. For those on the call who don't know a lot about ESG, can you sort of just give the high-level explanation of what ESG investing or sustainable investing is, what that looks like practically, and then maybe go a level deeper to explain some of the considerations that are at play when you're investing sustainably?
Yeah, so environmental, social, and governance factors, what ESG stands for. I usually just put them under the topic of sustainable investing. And what it means is different to almost everyone. So I always ask, when people ask that question, I mean, some people would like to, especially when they have, I guess, traditional experience in financial markets, would like it there to just be one answer. But it's a little bit like asking the question, what does it mean to be an investor in emerging markets? Or what does it mean to be an investor in a credit? If a client comes to us and says, I want to be an investor in either of those things, well, then there's a million other questions we have to ask. Which countries, right? You want to be invested in high quality, which sectors, right? Are you a global investor or not? So same thing with respect to sustainability. You have a full spectrum. We have, of our 2 trillion in assets under management, we have about 650 billion that qualify under some lens of sustainable investing, and that number keeps growing, where our clients will, at a minimum, have some sectors they don't want to invest in for concerns about sustainability. To then there's the other end of the spectrum in that group of investors. And I would classify the other end of the spectrum as people who want to really have an impact. They want to be able to measure. Yes, they care about performance, but they're not looking for, index exposure, or they're not looking to just beat the market. They have other objectives that they really want to accomplish with respect to sustainability. It could be, renewable energy as an example. It could be healthcare, could be education. They want to tilt that way in their portfolio. So it means a lot of things to different people. I mean, I have, why is this happening now? I usually say, well, it's happening now because increasingly people see the pace of change with E factors and S factors. And increasingly for business leaders and investors, be they large institutional pension funds, with hundreds of billions of dollars, or whether it's your retail investor, they realize that the current path we're on, it may have served us well for the past 20 or 30 years in terms of delivering prosperity for much of the world, not all of the world, and creating wealth and creating longevity, improved healthcare, innovation all over the place. But it won't serve us if we keep on the same path. It won't serve us that well for the next 20 or 30 years. It's because of some of the exhaustion of the E factors. It's some of the flaws in our model with respect to the S factors, which you can see within country, you can see globally. So the idea is more and more businesses and issuers, sovereigns, will be impacted by these factors, by this realization, this reality. And so as a traditional investor, even if you don't identify yourself as a sustainable investor, you have to think about these things and you have to incorporate them into your medium and long-term outlook, because they're going to have a big impact. Whether it's complete lines of businesses going the way of buggy manufacturers, which I would say fossil fuel companies know that's going to happen. They have to make big changes very fast, right? Or whether it's all the new regulations coming down that will in fact impact global businesses in a million different ways. Whether it's new regulation on cybersecurity and other flaws there that have been being continuously exploited. I mean, all these factors sort of fit under that umbrella of what is sustainable investing. Another way to describe it, and I like this one better in some ways, is just to say, at the highest level, okay, a focus on sustainable investing just means a focus on saying, growth can be bigger than it would be otherwise. It could be more inclusive than it would be otherwise. And it can be far more resilient. to shocks, whether it's a pandemic or other things, if we focused on sustainability. And so, it's not about, in some ways, people approach it and say, well, it's all about philanthropy. Look, that's a separate thing. Our focus as investors on sustainability is about delivering better risk-adjusted returns, taking into account these factors, and trying to make the pie bigger for everybody.
Scott, I absolutely love that, the second definition. I appreciate you sharing that you like that even more, this notion that growth could be bigger if it's more inclusive and it's more resilient to shocks. It raises a question for me. I'm wondering if, as you're having conversations with clients, I think since the time you and I first met, PIMCO's assets under management have grown by hundreds of billions of dollars, right? PIMCO as a firm is growing. Your impact is growing. Your reach is growing. And you, as an investor, making decisions and helping drive decisions with, again, hundreds of billions of dollars of assets, are in a lot of rooms that all of us on this call have never been in, right? We're actually talking to clients about their investing thesis, their objectives, their goals. Clearly, you're getting some potential objections, and you have clear answers to those potential objections for clients. And I'm wondering how you personally try to sort of direct or influence the thinking of your clients. Like, do you at PIMCO, do you personally feel like an obligation to try to direct people to more of the inclusive, resilient, sort of more of the hate, drive, and impact side of that spectrum you earlier described? Or do you take more of a stance that's wherever on that spectrum you land, as long as you are within, these two bounds, we will invest your capital responsibly, and you're totally agnostic to kind of where on that spectrum they land?
Well, we think it's our job to provide the best advice, but if, once again, if a client says, well, I hear that, but from my portfolio perspective, I know you're telling me that this whole sector, half the companies won't exist in the same form, 5-10 years from now. I understand there's risk with that, but I want to allocate to that sector. Then we say, okay, well, at least let us provide the advice to do that in the most sustainable way. And here I could just be talking about, let's talk about electricity generation or something like that, right? We can say, okay, here's the companies we think are going to be winners based on our research and what we know. They're going to be more profitable. They're not going to face necessarily the same, stranded asset problem, which is, basically having a stock of assets that nobody wants to buy from anymore. So, once again, we've always thought our role is to provide the best advice, and we want to do that with respect to sustainability and risk-adjusted returns, and have that discussion. That's just an important part of what we think, we need to do and what we're good at.
Right. That makes complete sense. And I'm wondering, in all these conversations with clients, to what extent do the clients that you're working with, or even people you're talking to in Wall Street or on the corporate side, issuers, do they see a trade-off between returns and portfolios being sustainable? Right, there's sort of this age-old concern that you're sacrificing, profit maximization, which is their duty to their shareholders, to be sustainable. How often are you seeing that? Have you been seeing that sentiment evolve or change over time? And sort of what's your response to that?
Definitely it's evolving, but we come from that as a history, right? I described the last, let's call it the last 30, 40 years. It was the supremacy of the shareholder. Nothing mattered. You didn't need to talk about anything other than returns to the shareholder. That's changing. There's lots of evidence of it. It's one of the reasons that this whole ESG and sustainability discussion is changing. It's corporate leadership changing. One, realizing that they can create value by focusing on all of their stakeholders. And so that's why you've seen really important organizations like the Business Roundtable, which has a couple hundred of the biggest companies in the U.S., put out that statement that was very important because it hasn't, this mindset hasn't changed for decades. But they said, no, we as a group agree that it's stakeholder capitalism that we want to promote, and that's better long-term value, which means we're looking at shareholders are stakeholders, but so are employees, and so are our customers, right? And so are suppliers. And so if you think about it more, which really is really a question of just pushing out your time frame and getting rid of some of that short-termism that is inherently, it's been weighing on us and weighing on what we could achieve at every level, because that short-termism has developed from this idea that the only thing that matters is next quarter's returns to shareholders. And so it's created this short-termism that Unfortunately, not allow a lot of companies to think about how to create value over the medium and long term. So in another way to talk about sustainability is just to say it's all about time frame, you know. And if you're, unfortunately, you know, the average tenureship at the senior level of most corporates in America is very short. So it's hard for them sometimes to think about, well, what am I doing for the company and my investors and my other stakeholders that will really provide value 5 years or 10 years from now, because they're not going to be around, right? And that's just the you know, the way it's been operating. So there's a host of factors, but the important point here is it's all changing. So, you know, usually when people say, well, if I focus on sustainability, will I destroy value? I'd say it's like everything you can do in investing. Okay, you can do it incorrectly and destroy value, okay, or you could get it right and create value. And more companies, big global companies, will describe it. And this is why you see, you know, probably I think it's the numbers over 80%, for instance, of U.S. S&P 500 companies issue now a sustainability report, you know, annually. And they outline what they're doing, and many incorporating it into their standard financial statements. So, you know, that number is just going to go to 100 because, you know, they're showing ways that they can create value, some short term, but also importantly, medium term, and by focusing on all their stakeholders. And it's just becoming more and more obvious. And many of the companies that I've interacted with will tell you, I mean, it's a clear, you know, value creation mechanism for them, right? They enjoy higher PEs, they enjoy more satisfied shareholders. And here's one more philosophy I have, okay, that maybe the reason why this works, and almost all the academic studies would say this companies that focus to some degree on sustainability and ESG are better performers. Well, why is that? Well, one, some of the things they're doing are adding value over the medium term, and they're pushing their focus out. But those tend to be the same companies that just have better management. I mean, they have the management structure that says, look, we're going to ask questions, we're going to stress test our business model, we're going to think forward, you know, we're going to try to stop thinking about next quarter and being obsessed by that, and think about the medium and long term. And that's why they end up doing better. So, you know, all these things are sort of linked together, and that's, you know, part of this like ecosystem that I describe of what's really changing, and there's so many different elements to it. But anyway, pretty interesting and exciting time.
Yeah, I would absolutely agree. I think we were chatting a little bit before the call actually started when you logged on. We were talking about how back in 2018, you know, there were 150 issuers. You were actually driving to improve ESG metrics, and that number has dramatically increased, right? That number is almost 10x'd in just a few years. That sort of leads to another question that I was thinking about over the course of the last few days. How client behavior, how investor behavior changes depending on broader market dynamics secularly. If you're in an uptrend or a downtrend, if we're in a secular bull market or a secular bear market, I'm wondering how you see client attitudes and behaviors around sustainable investing change depending on market outlook. When investors broadly, when the world is more bullish over the long term, are people more excited about ESG, and do you see that pull back a little bit in a correction? I'm curious to see how that evolves and changes.
Well, that is a great question. I'm not sure I know the answer, but I could talk about what's happened, you know, through the COVID crisis, which in many ways it accelerated the trends towards ESG and sustainability. Now, at first there was a setback, right? Because everybody had higher priorities. You know, how my business is going to survive? How am I as an investor going to do? You know, this could be really disturbing. But it also sort of made, I think, light bulbs go off, right? For investors, for investment banks, market participants. That vulnerability that we were all exposed to in that period in the pandemic has sort of opened people's eyes to this whole topic of sustainability. You know, with climate being the thing that really is driving a lot of that activity, because people realize that, you know, I described the current climate trajectory we're on as think about a pandemic that comes back. It's different every year and it's worse every year, and you can't do anything about it. Okay, that's what climate change will feel like if you don't get on top of it. So I think a lot of people can begin to understand the vulnerabilities and the linkages that before, you know, they didn't appreciate. And so, you know, if history's any guide, I mean, this particular crisis has brought renewed focus on it. But I would admit, you know, there might be other ways, perhaps if markets keep running the way they're running, people will lose focus on it again, and they'll just, short-termism. It feels so good to be in a bullish market that people might get more short-term oriented again, which would be a mistake. But I hope that doesn't happen.
I hope it doesn't either. Thanks, Scott. I appreciate it. And thank you on behalf of Scholars of Finance and to all of the world for those conversations that you're having with your clients, trying to encourage them to invest as sustainably as possible throughout, any kinds of market dynamics. To know that we have you there championing the major players to do great work. Another question is, you're sort of looking at client behavior, just company behavior across environmental, social, or governance factors. Where do you feel like you're seeing some of the strongest headway? I know you mentioned earlier the rate of change on E and S is clear. I'm wondering where you're seeing the most headway across those three types of factors, and also where you think we need more velocity, where you want to see things pick up.
Well, it's, broadly it kind of depends on where the investor's coming from, right? We have a global set of investors, and they have completely different priorities on sustainability issues. They could all maybe agree they're important, but depending on where they're coming from, they're going to have different priorities. What the big light bulb going off in the U.S. is, of course, is two things. It's climate and it's social inequalities for a host of reasons. People are very, very focused on that, and with good reason. But it's sort of like that's what's happening in the U.S. Of course, in Europe, they've been focused on climate for a long period of time, right? So yes, they'll continue to, and a lot of climate factors there. And it's, a lot of concerns there about global trade and about, the sustainability of that current model that they're experiencing themselves, right? It's with respect to technology and the threats they feel from that, which some are very real, and how those evolve over time. And supply chains, very much more concerned about that from there. Obviously, globalization, that's become a big factor for big global companies. And, in some regions of the world, there's a lot more concern about it. And I would say in Europe, that's the case. They're worried about where and how they're sourcing the cheap labor, and where the cheap products are coming from, and how that's happening. So, I just describe it as it's just a very different focus. So it's a hard question to answer. I would just say that, it's an uneven, and everybody's starting from a different place. So the most refreshing thing to see is it's just really generally rising everywhere.
Thanks. As you're talking about, again, the nuance by client, by company, and the different focuses that you need to place in different areas, it reminds me how much you've thought about sustainable investing for how long you have. And also the fact that you've really taken sort of a systems view, right, a 30,000-foot view, if you will, on sustainable investing. And you've been doing that for decades, right? You've been pioneering thinking on this subject, and you've been making decisions with enormous amounts of capital as a result of a lot of that thinking. And so I would love to hear your thoughts, sort of really looking out into the future, because I think inherently sustainable investing, ESG investing, if you will, requires investors to have a 10, 20, 30 year, in some cases, view to offset or to try, sort of combat some of those short-term profit trade-offs, right? They need to be thinking long-term. So can you, for all of us who are here on the line, and we'll listen to this, after the fact, can you share a bit about sort of how you think sustainable investing or just investing will evolve, not only in the next year or two, but sort of what your vision is for it in the next 1 or 2 decades? When you really look out long-term, what do you think the future holds?
Well, when I'm feeling particularly optimistic, then I would say the future holds, this transformation into more of a stakeholder mindset is going to be really, really important. And in a lot of ways, it's back to the future from that mindset. It's been more prevalent at other points in the last, couple hundred years and in different geographies around the world. But if that really is a trend that takes over, then we'll be largely on the right track. And we'll solve some of these problems, and the economic pie and the inclusiveness of it will be what it could be, which is massively bigger. But it really requires, in my mind, that this trajectory that when we have experienced, continues to accelerate, at the same pace. So much so that this just becomes mainstream, right? It's no longer a asset class or a way of investing. It is something everyone does, and it's a question of where you want to be and who's doing it the best way. So I think that is when I'm feeling optimistic. Now, when I'm feeling pessimistic, I'll say somehow if this slows down and plateaus and we don't fix some of the, let's start with climate. I don't know how much time people have spent with it, but the way that will impact the world in a material way, and we'd have to shift to start thinking about all sorts of things to kind of accommodate it. But it could be very, very socially disruptive. It could lead to wars. Actually, physical wars between countries would undoubtedly increase. I mean, if you want to feel pessimistic, you just spend some time looking at that type of outcome. So, most of the time I'm an optimist. I'm saying that, this increasing focus that you see is going to make it better. It's going to be so mainstream, even 5-10 years from now, that people will think about it in a totally different way, and be more medium and long-term focused.
Scott, I really, really appreciate you making that point and actually painting this vision of what it could look like for this just to not be, an asset class, to be sustainable investing. It's just investing. It's kind of hard to wrap your head around, but if you really imagine like 20 years from now, the term investing inherently implies that it's sustainable, and any other type of way you put your money to work is just gambling. You could almost see it become a stark contrast, like the difference between saving and spending. Are you investing, or are you just are you investing your money, or are you just gambling your money?
Yeah, and
you're thinking about stakeholder.
Yeah, exactly. So I say trying to think more about what investing means and the responsibility that particularly large investors have in thinking about. We always say it's the healthy markets, healthy societies, they kind of go hand in hand. And in some ways, the short-termism has meant that everyone has suffered more than they should. But if investors start to feel that way, and they start to think, I'm aligning that way, so I have confidence that even though I'm not as focused on some of the short-term things, my economic opportunity, my investment returns are going to be better 10 years from now than they would be if I didn't do this. And that's true of the whole market. If you get that shift, then that's the shift we're trying to get to occur.
Thanks.
We're
at 4:30.
I was gonna say, once I start talking about this, you're gonna have to cut me off. But no, it's excellent work, for instance, that the UN's put out on what it would mean. They have the 17 Sustainable Development Goals, but what it would mean, almost goal by goal, the potential, return on investment is so high. But once again, it takes time. But it's so high if you begin addressing those 17 development goals relative to what it would be otherwise, that everybody would say, well, what this is crazy. Why aren't we making all those investments right now, right? So it's beginning to happen. You hope the momentum keeps up.
Right, and that we can all, I think, collectively continue to drive that momentum. Because markets, Wall Street, all being largely psychological, it largely is what we decide it is, right? Wall Street investing, it's all a human construct. The earth wasn't formed with, a stock ticker going across the television screen. Like, we've created it, and so it'll become what leaders make it. And so that actually segues into a couple of questions that I wanted to ask, really about leadership, about success, how leaders can be successful in this kind of investing and can rise the ranks in this kind of investing. First, I wanted to ask you about your CFO Task Force. You and I have talked about this several times in our one-on-ones. Would love it if you can just share a little bit more about the CFO Task Force, what that means, what it entails, some of the results you've already seen, so the broader group can be aware.
Yeah, sure. It's so there's kind of a private sector arm. It's focused on private sector investment and activity from the UN called the UN Global Compact. They have 13,000 companies now that are signed up to that. It's the largest private network in the world. Big companies, small companies, every flavor. So we became very active in that organization. And one of the things that we observed was the disconnect sometimes between the C-suite, particularly chief financial officers. We ourselves, through our engagement, would end up talking to maybe treasurers or sustainability officers or investor relations, but pointing out the ways that they could improve their sustainability profile, and that rating agencies and ourselves, we would value that, right? And for good reason. But there was a disconnect because often the CFOs were in a different mindset. So what we thought is we have to do is get chief financial officers in a situation where they can rapidly learn from one another, share experiences, and that's how we're going to really, really make some big strides. And so we created this thing called the CFO Task Force. I co-chair that with the CFO from Enel, which is the largest utility in the world based in Rome. So it's really a global affair. We've got 50 very large multinationals, many more in the pipeline, with the idea that we need to grow it to about 300 by the end of the year to represent. And the idea there, we want to represent every industry and every geography, get all those experiences together. They can learn from one another, but then we can create templates. And the idea is to then show all the other thousands of companies, a clear example of where they can say, they can self-identify and say, that business looks a little bit like mine. I see what they did with respect to sustainability, whether it's in the capital markets, issuing things like sustainability-linked bonds or green bonds, or just incorporating sustainability into, kind of their value proposition, using it as a way to sell more to your clients, to make them happier, to make your employees happier, where the payoffs are sometimes a little intangible, but they could see examples of that. So we can do that. That'll be a big win. We think, leave that as a legacy for others to follow and help keep accelerating this trend. So that's the way we're thinking about the CFO Task Force.
Thanks, Scott. I appreciate you sharing a little bit. I'm really excited. We're going to be rooting for you that you get to 300 and hopefully well surpass that by the end of the year, of course. I know I'm going to try to make a few introductions myself and see if I can't personally help. Because I think the work is really exciting. One, I think, last question that I'll ask, and then we'll turn it over to Q&A with our students in the audience here. Would love to just hear some of the success that you've had and the firm has had through sustainable investing. What are some of the success metrics that you've been measuring and that you've seen? What are the wins that you and the firm have posted in the last several years?
Yeah, well, one I think is that group of investors with some sustainability focus of significant size keeps growing rapidly. So United is like 650 billion or something of the 2.1 trillion or so that we manage. But if that keeps growing, at some point it's going to be 50%, right? But it's been a big win to watch it grow and to have those discussions and provide that meaningful advice. I think other big wins, this sustainability linked bond market, which will ultimately be larger in our view than the green bond market. And let's put all those labeled bonds. We haven't gotten in details about what they mean, but that issuance last year was 540 billion, right? There's like a close to 40% year-on-year increase in the COVID year. So you can imagine if we keep getting that kind of growth, it's going to be a multi-trillion-dollar asset class. Now, behind that is a lot of work of what we've done, and we take some pride in that. We don't advertise it, but through our work with being on the advisory bodies of like the International Capital Markets Association, through the work we've done with investment banks and getting them to promote these instruments. It's a lot of work that we've been doing in the years that's kind of hidden from view. Through our work with the Global Compact, we basically invented this asset class called sustainability linked bonds. So, those people that know and know the history someday will write a book about it or something. But we've had a lot of great wins there. We actually have one of my colleagues is actually one of the people who invented the term ESG when he was working at the UN, and the PRI, the Principle for Responsible Investors, was part of that group. That group has grown to represent $100 trillion now. That group of principle, the PRI, Principles for Responsible Investment. We're very active in that one as well. So hey, there's lots of wins all along the way. In terms of market development, there's some other really exciting things that I could get into now that I think may happen, which would be really helpful for emerging markets. And we're talking to the IMF now about those. There's lots of interesting discussions ongoing. So if we can get something to happen there, it'll just be huge, right? It's one of these things that will change the world for a lot of people in a really helpful way for as far as the eye can see.
Mm-hmm. Thanks, Scott. Thanks for sharing the wins. And it's wonderful to hear some of the metrics around the coalition and the movement, if you will, around sustainable investing. To hear that there is $100 trillion represented in the UNPRI, for a lot of us on the line, that's an order of magnitude that we scarce can imagine. And it's very encouraging. It's very encouraging. At Scholars of Finance, we oftentimes talk about the problems that we need to solve in the world. They're not the kind of problems you start a nonprofit, raise $20,000 for, and solve. They are not even multi-million dollar problems, multi-billion dollar problems. They are multi-trillion dollar problems. I've seen some research that getting the planet to carbon neutrality, that's a multi-$100 trillion problem, right? So hearing the amount of capital that's stepping up and stepping behind, trying to make the world better through finance is incredibly exciting. And with that, I'll end our fireside chat, and I want to switch it over to our Q&A. So our students on the line, we already have a couple questions in the queue. Our students on the line can ask. So everyone on the line, want to just remind you, we're about to jump into Q&A. So if you can turn your cameras on, that'd be great. We are going to take a group photo in about 20 minutes. So you can start preparing now if you're still in your pajamas and want to just turn your camera on later. Otherwise, turn your cameras on. Remember to raise your hand on the Zoom chat to be added to our queue. Just introduce yourself, your name, your university, and ask your question. And we'll jump right in. Starting with Randall. Randall, welcome.
Thank you, Ross, and thank you, Scott, for being here. First of all, we really appreciate you for being here. Your insights have been amazing. Listening to you has been really insightful for me. So greetings, I'm Randall Leaf Jr., a third-year Finance Business Administration scholar from Cary, North Carolina, currently studying at Florida A&M University. And I understand that you actually have experience on both the U.S.-based side and then also the European side of the more so climate investing or sustainable investing spectrum. And I actually worked at Wellington on the climate research team for a good minute this summer. And when I was doing a lot of research on that, I did a good stint on the EU taxonomy. And I kind of wanted to understand how you kind of see that framework in your possible investment strategies, knowing how you can invest in global markets, the global bond market and stuff like that. And also how you kind of structure around sustainability linked bonds versus the green bond market, because I want to understand your discrepancies from both sides and how you see improvements in one security versus the other.
Yeah, those are a lot of great questions, and it sounds like you had some great experiences there too. We've, all along when they're developing the taxonomy, and it's still, of course, being developed because the new SFDR component, has more, you have more questions when you're an investor and you're needing to comply with those reporting standards than you have answers at the moment. That'll get sorted out over the next year or two. I guess overall, it's been a great thing, the EU taxonomy, which basically to say, let's define what is green and let's define what is sustainable. But in a lot of ways, to me, it's too prescriptive. Okay, because it basically, you're trying to say, well, that activity isn't, even though that activity might not be, but that company might be headed in the right direction, very much focused on sustainability. So the elements I don't like are the the idea that everything is quantifiable and you can be very prescriptive about saying what it is today. The other thing is it's going to change. It's going to look different 5 years from now. So what happens is if you create these legal frameworks, they never can keep up. So I've been a little bit advising them all along, great directions, but don't be overly prescriptive in any one category. Let the private sector take care of it. Let markets develop. Let markets experiment. Ultimately they'll figure it out, right? And so, a lot of the issues with the taxonomy now are that, they can't decide exactly, what to do with things like sustainability linked bonds and those types of things. So how I define those, and that's one of the reasons I'm excited about sustainability linked bonds, is there's so many sustainability focused objectives and needs that we have. They're not all qualified for a green bond. Green bonds are important and that market is growing. It's hugely important. But what about all the other issues on sustainability? So why not create this asset class where green bonds are a subset of that, but then, there's social bonds. A company, very focused on sustainability and making great commitments in so many different areas. Maybe it's supply chain, maybe it's the social investments they're making. Let them issue a capital markets instrument reach a little bit, right? And then let investors really focus on that. So to me, that's why it was really important to help invent that market. And why, we were successful and, we got the European Central Bank to start, adding them to the menu of their investment activity. But it's through us and a couple others that approached them and said, you can't just be green bonds, right? I mean, you got to, here's a new asset class and think about it that way. And that's been very powerful in getting more people thinking about the issuance they can do there, because they know, well, the ECB, the central bank, will be buying them. So anyway, that's how I think about the EU. So in thinking about how the US evolves, our advice to regulators, the SEC, which has an open comment period now, and others is, head in that direction, but don't take it the step to be too prescriptive too early, because it's, these regulations will never keep up with the innovation and the needs that we have in the financial market and what investors want to invest in. You can't just tell them not to do it if they have good reason to think it's aligned with sustainability, just because it doesn't have the label or meet this certification requirement. So that's generally going to be our advice. Take the best of what's been done already in places like Europe and improve upon it. But that doesn't always mean more. Sometimes it means a little less.
No, thank you. Sorry, to follow up, I just wanted to ask about your so you were talking about the regulatory environment and how it kind of coincides from the EU to the US. And I understand that policy in the US is a lot more stringent. So how have you kind of adapted your methods or investment strategies from the US from the EU to the US?
Yeah, well, some ways, I mean, the EU is a little bit more, it's more complicated, right? Because the standards and requirements, even though there's the EU, guidance and the taxonomy is really different by each country. I mean, for instance, the requirements to be successful and sell your investment and your products into different geographies is still not one Europe. The US is a little bit, we've had a very active SEC and a very, we've really, it's really been focused, Dodd-Frank, everything else, really more disclosure. Let's operate super clean financial markets. And as you mentioned, that's been really valuable. But, the US in thinking about sustainability is far behind, right? So that's going to change, I would forecast, in the next year or two, just because of the amount of activity and inquiry that we see from every agency of the government. It's not just the SEC, it's the Treasury Department, it's the US Fed, it's the administration, it's the new climate coordinator. So their idea is, well, in following in the footsteps of what the US has always done so well, which is requiring consistent top quality disclosure on traditional metrics, what if we could do some of that with respect to sustainability and climate objectives? I think that'd be great, and that'd be very valuable for us as investors, just to have a more consistent framework. You can link it to the financial statements that could even become part of the traditional financial statements. So I think that's the direction we're moving. The mistake would be is if we move in the direction of saying that in the US, we know today what is sustainable and what is not, and we're going to force people into those products. Like you can't make up your mind, yourself as a large investor, because we're going to tell you that that's the way it is. And so that could slow down the development, and it could slow down people's progression, right? A lot, right? And the kind of the iterations and discovery that needs to go on. So I just hope that doesn't happen. I don't think it will. I mean, I think we and others will provide that advice, and the US will follow an incremental approach, which I think is better than maybe let's just copy everything Europe has. Yeah.
Thank you. That was very insightful.
Great questions, Randall, in my opinion. Maurice, you're up next.
Yes, thank you, Ross. Good evening. I am Maurice Gilbert, a third-year economics and political science student from Ocala, Florida, and I'm also attending Florida A&M University in Tallahassee.
Excellent.
Thank you. I'm curious to hear more about your thoughts on what do you think has been more motivating for large firms to be more active in their transitions to further sustainability. And some ideas that I had were sustainable investing itself, consumer taste, government or potential fear of government regulation or motivation by government regulation, or any combination of those factors, or even an additional factor.
Yeah, it's been all those things, and that's why it's this whole, it's a group thing. And, the other, frankly, for some of the biggest companies, it's a fear of being left behind. They notice that other people in their industry are doing more, getting more credit for it, from whether it's from policymakers or their customers or their employees, which employees have been a huge driver of some of these movements. And so then they start reaching out saying, well, how can we do better than our competitor, right? And on these issues. And so it's just a question of raising the bar all the time like this. And the pressures to raise that bar come from all sorts of directions. So, and at different moments in time. So that's what I sort of mean by the whole movement changing, changing the way businesses think about these issues and changing financial markets as a consequence.
Thank you for that. And of course, I've definitely just been a personal observer of that, especially I've taken note of the auto industry and how now every major automaker not only is planning one electric vehicle just to satisfy government regulations, but are planning entire fleets to turn to electric vehicles and transform. So that's definitely something that I've noticed in that industry in particular. Thank you for that, though.
Yeah, it's interesting. And, some of these same companies, 2 years ago, I mean, they had no plans for electric vehicles. Now the plan is like, well, we're going to stop making internal combustion engines in 5 years. I mean, just a huge transformation. I mean, but frankly, some of those companies, I was kind of, beating my head against the wall, wondering what the heck they were doing. And we've had discussions. We're large investors in those companies, but we had many interactions trying to say, well, what is your medium and long-term plan here? The world is changing much faster than and I think they're catching up with that.
Amazing. Great question, Maurice. Thanks, Scott, as well. Elias, I see you're up next.
Yeah, thanks, Ross. Hi, everyone. My name is Elias. I am a fourth-year student at the University of Minnesota studying finance. Scott, I'm curious about the quantifiable side of ESG. And so I'm thinking from a bottom-up perspective here, as you're building out valuation, how are you, quantifying all these ESG factors, right? Like you could do a screen, you could look at the SASB materiality map, but what are you actually building into models to show valuation from an ESG perspective? And then maybe how have you seen that develop over the years?
Yeah, that's a great question, and it's one of the issues that drives the more quantified folk, the quant investors nuts, because the data series isn't long enough in most cases. It's not consistent enough to make those judgments in isolation. So our approach is to say, let's take all the data sets, then let's take our own view. Let's also keep pushing for, and that's why we're always pushing for consistent disclosure, within different industry groups. It doesn't have to look the same within an industry group or between industry groups, but certainly within, it makes sense to have that consistent disclosure. And so why we're involved with SASB and others trying to push that forward. There's many different models, many different data providers out there. So I tell you today, our quants took and tore up every single, piece of information everywhere they could to see if we could do something meaningful with that. We just decided, look, they're all meaningful inputs, but it's not consistent. There's not enough history. So we really have to overlay some judgment, and we have to go and ask these companies that we're investing in for some of that data and for that to be disclosed in a more consistent fashion. So that's what we're doing. Just on the issue with respect to climate, you think how challenging this could be, because even the companies that are reporting metrics, they're all different. And so when you do, and they're not really consistent, and sometimes the same company from year to year keeps changing the methodology. So it can be a nightmare. It's going to be getting better, I'm sure of that, but it's really, really difficult. So my words of wisdom is, consume all the data that you can, be as quantifiable as you can, keep advocating for better data. We'll get there, but it's going to be a journey. And in the meantime, our approach is to say, we have to form our own subjective judgments around a lot of these things. We have our own ESG scores, which are quantitatively based, for instance, things we invest in. But that's where we go and we say, this industry, here's the weightings, here's what's material. We're going to fill in these pieces and arrive at a score. Doesn't tell you everything you need to know, but it's an attempt to be, to turn things into, very quantitative sorts of factors that we can track over time and see what's working and what's not, and where we can, advocate for for different disclosures or something we think is more helpful. You know, there's a big, as you know, there's a big push for, and you see more and more companies announcing plans to be carbon neutral by a certain point in time. But you know what? They all mean different things. When you dig into the details, what they're all saying to get carbon neutral, they're all talking about different things. You know, they're all, and so you really, it's very difficult when our job is going to be as investors to develop a map for every one of these issuers of where we think, what trajectory they're on. Where will they be in 2025? Where will they be in 2030? Where will they be in 2050? And their commitments and disclosures keep changing. But just describing some of the interesting things that are going on. And of course, you see governments doing it too, right? The U.S. committing to be, carbon neutrality by 2050. Now, tell me what that means. How is that going to happen? And those definitions are really important. So anyway, that's why it's lots of fun.
Great, thank you.
Thanks, Elias. Vivan, I see you're next.
Yeah, hi, Scott. Thanks so much for being here and giving us this presentation. It's been so fantastic. I'd love to hear your kind of view on how stakeholders in companies and shareholders in companies can kind of work towards, pushing management in more aggressive directions to kind of implement sustainability efforts. I know a lot of institutional investors, Vanguard and State Street, and Fidelity they don't vote in favor of proxy votes to kind of advance these sorts of efforts, and how can kind of we work towards encouraging these institutional investors to do that, and force companies, not force, but incentivize companies to work towards that as well.
Well, I think it's, every investor, I would say, has a voice, whether they decide to exercise their own, proxy vote. They can certainly direct their own investment dollars in that way, which investment asset managers will interpret and react accordingly, right? They see more people moving into their sustainability linked funds, or their funds really focused on, you pick the element of sustainability, whatever it is. They will respond, by upping their commitment to get companies moving faster. And I would say, also just, employees, right? Consumers. I mean, they really do have a voice. And there's also these networks that are built up, which are, can exert some pressure. And surprisingly, I mean, they're valued. They work. So my voice, what I say to most people is just, look for those networks. You connect to them, and you'll have a voice. And as an investor, even if you're a retail investor, you're not going to have the voice of a big institutional investor, but you still can be very influential, whether it's even, just with your own investment dollars, moving them in that direction, or whether it's voting yourself instead of letting, the big financial providers do it. If you don't like the way they're doing it, it's writing those letters, if you feel like it, to your investment advisor and saying, show me what you're doing in the space, and trying to hold them account to a higher standard. So there's all kinds of things like that.
Thank you.
Awesome. Thanks, Vivan. Randall, I see you raise your hand again. We have 5 minutes left, so I think you may be our last question, unless we have a few minutes after you're done. So we'll turn it back to you to ask another question.
I appreciate it, Ross. And again, thanks, Scott. So I actually wanted to talk to you because my project over the summer, so when I was dealing with climate research, I dealt with a lot of data on the MSCI and true cost frameworks mostly. And I kind of wanted to understand your perspective in terms of raw data accumulation when it comes to investment firms, and how they can really start to become more abreast of the possibilities of implementing screening methods, and also just risk frameworks associated with those data providers, and how they can become more abreast of the situation at hand in terms of the quantitative, more so like the less developed quantitative background that is around climate research currently.
Mm-hmm. Yeah, well, there's lots of, as you know, there's lots of gaps in the data, right? If even from individual, the data sets keep getting larger. But like when we look at the fixed income universe, there's still huge missing segments where there's no data from each data provider, which makes it very frustrating, because a lot of people want to say, well, why can't there just be one data provider that gets all this data in and does it right consistently? I don't, look, eventually we'll kind of get there because there's a massive battle going on right now for this as a business, right? So yeah, it's the true cost, it's MSCI, it's Sustainalytics, and then now it's what I say, the other big four. I throw Bloomberg in there because they're trying to do it their own way and they're more and more data. And then I put, Moody's, S&P, and Fitch, all trying to do that because they realize how important this is going to be, and it'll be important as a business to provide that data to people. So once again, they're all going like this, and our approach, I guess advice to most, investors would be consume it all, filter it for what you think makes the most sense and is most consistent. And there's, keep trying to fill in those, that's what we do, is just consume all the data, keep trying to fill in the missing pieces, focus on those. We apply pressure from our data vendors, right, to fill in the missing pieces. So it's just an ongoing thing that we have to do. I don't know if that answers your question, but that's sort of our approach.
No, it definitely does. And that was like, that brings me to like the next part, which is kind of around the actual financing. So when you actually do make your like financing decisions or like your investment decisions behind it, do you guys typically utilize like a threshold that they have to have for emissions intensity, or what kind of screening process do they have to have? Because I understand like traditional banks or like large investment banks actually implement exclusionary underwriting policies around fossil fuels and other like areas where they literally can't finance them. And I kind of want to understand how you guys kind of put that into your scope.
Right. So we, and it's not the same. It's a great question, but we have certain products that do that, and I think they have a very high standard in terms of exclusions, right? From traditional fossil fuels, from weapons manufacture, from violations of the UN Global Compact, from international rights claims and controversies. But those products then, they really focus then on the next level too. It's not just exclusions, but we also approach it from saying, okay, well, let's look at then how we can build a portfolio that massively beats on carbon intensity. How can we build a portfolio that massively beats on science-based targets and trying to get to carbon neutrality earlier than 2050, because that's going to be too late. It's no good if you announce plans to get there in 2050, but you don't develop the plans to start moving till 2040. So, little subjectivity comes into these things because we have to make those assessments. But, our goal in delivering, when we deliver a sustainability focused, let's call it a mutual fund, we want it to be best in class on risk-adjusted returns and on sustainability targets. It's never good enough for us to go like, yeah, let's just throw out a few things because some other people are doing that. Is to try to keep raising the bar, and that's how we think we'll continue to have appealing products for people. We're not trying to be everything to everyone in the space. There'll always be important other approaches, but for us that makes the most sense. And then everything we do benefits from our increased ESG research that we have into every single asset class. We score everything. So it's sovereigns, it's corporates, it's municipals, it's even mortgage-backed securities, asset-backed securities, right? It all could, there's all frameworks you can develop around all these things which are helpful. So that benefits everything, every investor that we have across the 2.1 trillion, right?
Awesome. Thanks for the great final questions, Randall and Scott. Thank you so much. I know we're at time, so we'll wrap up here. With that, Scott, I want to thank you again for joining us. We're incredibly grateful and are inspired by all the work you're doing and that you've done throughout your career. Thank you for your continued support of our mission at Scholars of Finance, continuing to teach us how we can finance a force for good, how we can give back and make the world better through our investing decisions. So just want to wish you a wonderful week. Everyone else want to wish you a wonderful week as well. Scott, excited to have you back again, and thank you so much.